I'm absolutely delighted that we have Verena Ross with us. Verena Ross is, of course, the chair of ESMA, the European Securities and Markets Authority. Verena wants to explore some of the elements around artificial intelligence, fits perfectly kind of with the previous themes, and also blockchain, which was exactly the theme of the previous panels and interventions, Verena. If at the end I might ask you 1 or 2 questions on MiCA as well, maybe that might be possible because we're getting a lot of questions coming from the audience on that, but let's see how it goes. First of all, thank you for being with us and supporting us as you've done in the past. It's a real pleasure to have you with us.
Thanks very much, Nick. I hope you can hear and see me okay.
Yes, perfectly.
Great, fantastic. I'm saying hello to you from Riga today. You just see what the virtual world can do for you. And I'm really delighted to take part in this year's event again. And thank you, Nick, for inviting me. As you say, my remarks today will cover developments in 2 areas of digital innovation that have been in the headlines recently. First, crypto assets and distributed ledger technology, informally also known as blockchain, and secondly, artificial intelligence. Across the financial sector, there are growing applications and use cases of blockchain and artificial intelligence. And the underlying technology is obviously highly sophisticated. And indeed, at times, at least for me, artificial intelligence applications can make it seem like we're living in the realm of science fiction. Our job as regulators is to keep track of innovative finance and to assess new tools and practices against our core priorities. And at ESMA, that obviously means that we need to ask ourselves continually, how do we protect investors, promote stable and orderly markets, and supervise markets effectively? So let me first turn to the crypto side of things. Recent months have seen some highly concerning events unfold in the world of crypto assets. Foremost amongst those was obviously the collapse of FTX, one of the most prominent crypto trading platforms in November. Headquartered in the Bahamas, FTX was part of a complex corporate structure spanning several continents, allowing users to buy and sell crypto coins, tokens, and derivatives, sometimes with really high leverage. And its bankruptcy sent quite some shockwaves across the entire crypto industry and is likely to cause also major detriment, unfortunately, to retail investors, including to a few in the EU. The relevant authorities are continuing their investigations into this complex case, and I will not want to discuss that in detail. But I think we should recognize that the episode is an important juncture in the development of crypto markets. ESMA and other authorities have been warning publicly for some time about the severe risks crypto assets can pose to investor protection and market integrity. And crypto assets are typically not backed by any tangible value, and their prices are highly volatile. Most operate outside the scope of EU regulation, at least, meaning that consumers do not have the rights and protections they might have in other areas when things go wrong. Yet crypto assets appeal to many consumers who increasingly can trade them at a touch of a button via one of the many fin apps that are around. And we continue to see also crypto assets promoted quite aggressively on social media, with consumers exposed to unverified information, often widely exaggerated claims. And to my knowledge, that is continuing despite the fact that we had this big event and the general downturn in the crypto market. The existence of crypto scams and fraudulent activities have been evident for some time, but I think with FTX, the risks have really materialized on a large scale. Fundamentally, the episode corroborates existing concerns about often weak or flawed corporate governance and controls in the crypto assets space. You just talked about it, the new MiCA regulation was developed without prior knowledge of the scale and nature of the problems that arose, for example, in the FTX case. MiCA is nonetheless, to my mind, an important milestone in crypto asset regulation. It will introduce a new protection for investors and new rules for market participants through a common European regime. Crypto asset service providers, CASPs in short, will for the first time be subject to authorization and supervision by national competent authorities. At the same time, and while it is the first comprehensive regulation of previously unregulated crypto assets in the world, I believe, we must acknowledge that MiCA is not the silver bullet. For a start, it is inevitable that it's a European regulation and with that limited in its geographic scope. And also service providers outside the EU have, as we know, a prominent role in crypto markets. And it seems likely that they will continue to have that. If consumers in the EU seek out the services of providers based outside of the Union, they will be outside of the European Union protection that MiCA can offer. However, there's also the issue of the actual provisions in MiCA, which basically are, even within the EU, giving protection to investors that's not quite at the same level of those of MiFID, for example, nor are the market integrity rules as stringent as those in the market abuse regulation. In short, crypto asset markets will not suddenly turn into these mature and established securities markets that we are used to, and it is important that we are clear about that distinction also to investors. Another difference is the surveillance capabilities of authorities that in traditional markets mean that we can really have a good view of how these markets are functioning. In the crypto asset markets, that is not going to be the case. And so we won't have the reporting and market surveillance regimes that have been developed and strengthened over many years. And competent authorities have extensive information at hand about supervised firms and are able to assess risks in these traditional markets. That won't be the case in the crypto markets. On top of this, crypto asset markets continue to evolve quickly, and MiCA will certainly need to be kept under review for that purpose. We will need to make sure that it stays up to date in light of market developments, and that also the perimeter of MiCA is constantly relooked at and assessed, given particular emphasis on changes such as non-fungible tokens and decentralized finance, which are clearly coming up the agenda. ESMA will have a substantial role in implementing and applying the new MiCA regime, which is a really urgent task for us. From a policy perspective, we will have to draft dozens of technical standards and guidelines, working closely with the EBA on that, obviously. And we will also have coordination duties to make sure that actually when these service providers are coming into the EU, that there is a consistent approach between national supervisors as to how they are supervised, authorized, but also that we provide the necessary coordination and cooperation with our counterparts internationally. We will also have the task of creating and maintaining a public register with detailed information on e-money tokens, asset reference tokens, and CASPs, as well as complaints handling. We will need to here build a user-friendly register to promote the transparencies of these aspects of the crypto markets. So we will certainly have quite a lot to do. A final observation on MiCA is that ESMA will also be given intervention powers, somewhat analogous to what we have in MiFIR, which we last exercised in 2018. And ESMA will be able to prohibit or restrict the provision of services by CASPs or the distribution or sale of crypto assets in cases where there are threats to investor protection, market integrity, or financial stability. This is quite an important and challenging new mandate for ESMA, obviously. I would like to leave you with the impression that blockchain technology only creates risks and problems. I think it's important to emphasize that this technology has other applications beyond crypto assets. And our job as regulators is to identify where applications can bring benefits to markets and investors and where there are risks, and how we can ultimately balance that in our regulation and supervision in supporting beneficial innovation in the market. DLT-based financial instruments, for example, have the potential to speed up settlement cycles and to bring greater efficiency to back office functions. Recognizing this potential, the DLT pilot regime aims to support the development of the trading and settlement of DLT-based financial instruments. The pilot will enter into application in less than 2 months now, on the 23rd of March, and will allow the uptake of MTFs and CSDs that leverage on blockchain technology in a controlled environment. The potential benefits include obviously enhanced speed, efficiency, transparency, and so on. And so as long as such automation is reliable, it can clearly benefit markets and ultimately investors. NCAs here as well will authorize and supervise firms under the pilot regime, but ESMA will have an important coordination role to support convergence across the EU. For example, we'll have the possibility to issue opinions to the national authorities and provide guidance. Let me now quickly turn to the topic of artificial intelligence, or AI. Since its launch in November, ChatGPT has been in the headlines. It's a chatbot that, while maybe imperfect, has some quite impressive and uncanny possibilities to reply to questions. It is therefore a tool within the field of natural language processing, or NLP, which itself is a subfield of the artificial intelligence. At the same time, it is an example of machine learning, using vast amounts of training data in the form of text gathered from across the internet. Human beings have helped train it, not just in devising the underlying code, but also giving the tool feedback on the quality of its verbal output. ChatGPT has reportedly been kept rather busy since appearing on the scene, apparently even passing an MBA exam, I read. This clearly poses some immediate and urgent questions for educational establishments, and in the financial sector, maybe for the administrators of professional exams and qualifications. But it also raises questions for authorities such as ESMA, which I will come to shortly. But first, to set the scene, let's return to the year 1950. Alan Turing, the great pioneer of computer science, proposed an imitation game at the time, since named the Turing test, to determine whether a machine exhibits intelligent behavior. A series of questions is asked of the machine, as well as of its human competitor. The machine passes the test if another person asked to judge the responses cannot tell whether the response comes from the machine or whether it comes from the human being. At the time, this prospect may well have seemed far-fetched and real future science. Indeed, almost 3/4 of a century later, ChatGPT does not always give entirely convincing answers, but it does do a remarkable job. Sometimes it's worth taking a step back to marvel just at where we have got to in all of this. And I note that there are several firms competing to innovate in this area, and I certainly think we can expect NLP tools to continue to improve. What do these advances in natural language processing mean for financial markets and regulators? A direct potential application of new chatbots is in consumer interactions, very clearly. The European Commission's proposed AI Act, which applies across the economy, not just the financial sector, recognizes the importance of transparency in this regard, requiring that clients are made aware that they are interacting with a tool. Another potential application for natural language processing tools is to automate compliance procedures, such as around disclosures, or even to write analyst reports. Certainly, we at ESMA have been closely following developments in the NLP and AI more broadly. Last week, we published a research article on current and potential applications of AI in the securities markets. We have not seen a fundamental or disruptive shift to using AI tools, but some noteworthy developments prompt continued monitoring, dialogue, and analysis by ESMA and other authorities. And certainly staying in touch with how the industry is developing is important here. Increasingly, asset managers are using AI in investment strategies, risk management, and compliance. However, very few currently have a full AI-based investment process and publicly promote the use of AI. Other entities, such as credit rating agencies, are also increasingly making use of these tools. But AI and NLP are also able to add value to us as regulators and supervisors. With ever more data and information that we need to make sense of, these tools can help drive more efficient and effective data-driven and risk-based supervision. AI-based processes can bring benefits in the form of speed and efficiency, but where will this all lead to in terms of risks? Without wishing to speculate, it is worth considering plausible scenarios when assessing current and potential risks. Increased uptake of AI in the financial sector may lead to the concentration of systems and models among a few big players. More generally, AI models may be more complex and less transparent than more traditional statistical approaches. To address these issues, financial entities will need appropriate governance frameworks to ensure accountability and responsible use of AI tools. To sum up, recent media focus on two major events, FTX and ChatGPT, have highlighted some important longer-term developments around blockchain and AI, respectively. Regarding crypto assets, MiCA will address some key issues, though we must be conscious of its limits and remain vigilant to ongoing and emerging investor protection risks in this area. We will, as ESMA, work on implementing MiCA in coordination with other EU and international authorities, and we will make sure that these rules are applied as effectively as possible. Regarding AI, we will certainly continue to assess market trends and make sure that as supervisors and regulators, we are fully aware of how the industry is developing in using these tools, but that we can also make use of them where that makes sense for us in this fast-moving field. Thank you very much.
Verena, thank you very much indeed for these very interesting words. And I see there's a few questions coming in, and I think you agreed to take a few questions. And maybe I start and see, as I say, as we see what else is coming in. But one maybe more housekeeping point to start with on MiCA. Obviously, we will have to wait for the formal publication of the piece of legislation, but there's a huge amount of level 2 work to be done on the basis of MiCA, most of that falling to you and your organization. Although Jose Manuel has already pointed out a bit that he has to do around stablecoins. How do you envisage the time frame for that? What's the plans around, consulting, prioritizing those respective RTSs, and at the same time, as you say, contributing to supervisory convergence on how your respective members apply the rules during the transition period?
Thanks, Nick. Indeed, now that we are getting hopefully close to the formal publication in the OJ, which we're expecting around May, I think, we are already getting started to working on the numerous level 2 and level 3 mandates that we have under MiCA. It's ambitious. I think altogether there are more than 30 mandates for ESMA, many with only a 12-month deadline, which is not very much if you want to consult. So considering all this timeline, we are currently working through the various aspects and are working through how we can best basically do that consultation in a sensible way to bring input at the right time. We will probably not be able to do what we've done in other cases sometimes, to first do a discussion paper and then a consultation paper, because the timeline is just too short. But what we are currently thinking about is probably grouping the consultation papers in 2 or 3 different packages. First one probably to come out even before the summer break, so very quickly after the publication in the OJ. The second one after the summer break, and then a third and final one at the end of the 2023. But that's the current kind of vague timing. On the work with the NCAs on convergence, we already have actually a crypto asset task force, which is bringing the national competent authorities together even ahead of having a formal legislation agreed and published, because we wanted to make sure that the national competent authorities talk to each other as they are getting approaches and challenges about how to deal with different crypto asset proposals in the financial field that they have responsibility for. And we will build on that and try to see what more we can do to also look at how NCAs are taking forward their authorization responsibilities and are starting to think about their supervision responsibilities, and try to make sure that we bring the NCAs together in as much as we can in that process.
Thank you. A question came in which might be kind of too forward-looking, but in a way reflects a bit what happened around FTX. Not the scandal and its demise, but more in the early days, its rise and the excitement around FTX, because your colleagues, so to speak, at the CFTC in the US even granted them a formal supervisory framework as a clearinghouse. It was kind of moving towards the possibility of seeing how blockchain and certain tokenized representations could be used to streamline the clearing and settlement process. And the question that's come in is, what does it take beyond the pilot project to see blockchain as a possible technology that could be used for clearing and settlement purposes in the security markets? And also the use of wallets rather than accounts, allowing individuals to be more responsive and engaged in their own control over their own assets.
No, I think you're putting your finger on the fact that we need to look carefully at some of the benefits this technology can bring. And I think that is something which we've done for quite a while. We've engaged a lot in the trading and post-trading infrastructure uses of this technology. What I personally find interesting is, and that's I think where the DLT pilot will really shed some light, is how pervasive will this become in the financial services industry as we know it, and how will that change the post-trading infrastructure over time? Because in some jurisdictions, we're now talking about moving from T+2 to T+1. Blockchain clearly is a completely different leap from that. And I think it will be interesting to see whether that really has the scalability to provide that post-trade infrastructure on a blockchain, which opens all new possibilities for greater efficiencies, for potential greater transparency, for ability of monitoring and supervising, which I think are things that could be very interesting. But it really has to be seen how that will develop in the industry, to my mind.
Just to give you some feedback, we're getting comments in saying that the DLT project is a nice first start, but it's not even a baby step. It's kind of the first picture of the baby, so to speak, in the womb. It's not even there. So people are a bit frustrated about the lack of ambition, but that's not for you. That's for the co-legislators, to be honest, and what they wanted to do.
No, but I think it would also be really interesting to see how some of the established players have clearly looked at using that technology, but so far have only really used it in very niche and specific applications. It hasn't really gathered that kind of wider acceptance. And I think that's not just a regulatory constraint. I think there's also a real application and industry consideration that hasn't quite made that leap yet, to my understanding. And by the way, I think the CFTC was considering an application. I don't think they had granted it yet, to my knowledge, but I might be wrong.
But Ross Benham can send in and clarify. I thought they had, but in any case, it doesn't matter. Even that they were considering it very seriously, I think, is an interesting step.
Yeah.
So, good point. I think one question on artificial intelligence. We've discussed this in every single conference for 7 years, and particularly around robo-advice. And you mentioned robo-advice. and the importance around it. I mean, do the existing rules around advice, dealing with the customers, customers' best interest, need to be amended in the light of these applications, or do you feel comfortable that within the context of robo-advice, through the design of the actual underlying artificial intelligence, fund managers or broker-dealers can already take this into consideration? So basically, do you think if we see a rollout of some of these AI applications that we have to go back to reviewing MiFID or other kind of conduct-related rules?
I think it's something we need to look at a bit further, but my initial reaction would be that the core principles of MiFID clearly apply whether you give that advice as a human or whether you use some artificial intelligence to support that process through robo-advice. Again, in this space, actually, most of the industry applications that we've come across have used artificial intelligence in very limited aspects at this point in time. And that, I think, is because one of the things that MiFID would clearly require is that there is a proper way of adapting to the investor all through the process to make sure that you are not just giving the kind of pre-scripted text, but that it really has the ability to give the best possible advice to the investor. And that is something which I think some of the applications still find difficult to do. And I think, but there's clearly prospect here for more of this. And I think there's also a real opportunity to provide ultimately advice in a more streamlined, efficient, and cheaper way that will allow more investors to get access to advice in a very different way. It won't be the same as what they get when they walk into their branch and speak to their kind of bank advisor that has accompanied them for 20 years, but it will be something that might work for some investors rather well. But it will need to have the right controls and the right regulatory framework that, to my mind, MiFID, at least on the principles level, does provide. You might need to look at some of the details within that.
Looking maybe at trading strategies, we had already in MiFIR 2 the debate around high-frequency trading. And in a way, high-frequency trading was a different way for algo trading or robot trading. So using artificial intelligence in trading strategies. Other than around market abuse or insider dealing type elements, do you see any need in that area for potential future action?
We did quite some work on algo trading and high frequency trading, obviously, in the review of MiFID, where we also provided some further advice to the Commission. And so I think there are indeed some areas that need to be looked at, particularly when it comes to direct access of some of these algo systems to trading platforms and how that needs to be controlled to make sure that you don't end up with something going wrong in one of the systems, and with that launching a whole big issue on the trading venue where suddenly you can't have any idea anymore how this kind of self-developing snowball started and how to stop it. So I think there are important things around control mechanisms, governance, and all of that. We've recently also published a paper on the parameter of trading venues. And I think that is something which, again, because of the technology that is coming in, keeps on changing frequently. And I think it's just on us as regulators and supervisors to constantly monitor how far our regulatory regime still is able to cater for what is happening on the ground in terms of the adoption of new technologies, and making sure that in the regulation we properly balance the risks and opportunities these bring.
Thank you. That had actually been my last question, but I think to give you feedback, I find that paper very interesting that was published just a few days ago, because it speaks to what you said about robo-advice as well. You're looking at the application, you're looking at if it looks like a trading venue, if it behaves like a trading venue, it should be classified as a trading venue, and you take some high-level principles, 3 high-level principles that dictate kind of the supervisory approach. And I think it's an interesting way of looking at new technologies. It's kind of looking at the outcomes-based and the comparability to existing structures as a proxy for determining whether new technologies should follow the same regulatory framework. I think it's a very interesting way of approaching things, Verena. Thank you very much indeed for being with us and joining us. The benefit of doing this virtually is that it's a bit easier to accommodate all your schedules, and in this case, your travel. It's kind of one of the positive sides of technology, even though it's not as sophisticated as the metaverse, as we've just learned. Yes. But thank you so much for being with us and for your thoughts on both crypto assets and DLT on the one hand and AI on the other. Thanks, Verena, as always.
Thanks very much, Nick. All the best.
Thank you.